I
He got
remember this. You were
yeah.
saying bond yields go up every time there's QE, and everyone was thinking they're buying bonds and bond yields should go down. I remember seeing that going, huh, he's right.
Talked about bond yields over and over on shows, and we haven't really gotten it right a lot of
I
times because
can't trade bonds anymore. I used to be really good at bonds. I just cannot get them right.
no, it seems like this thesis that central bank balance sheets impact bond yields in the way you just described is not really working as it intended anymore. So we need to come up with a new thesis on that. But that was my first thesis, and it played out very beautifully.
Hey guys, welcome to Everyday Finance. The inevitability of currency debasement and the deflationary impact of crypto technologies are at the center of Raoul Pal's expansive thesis on the future of global markets, which he presents in a comprehensive manner. Pal warns that central banks will likely resort to more money printing and liquidity injections in order to keep economies afloat, which will set the stage for further erosion of the value of fiat currencies. This comes at a time when governments all over the world are struggling to manage inflation and ballooning debt loads. On the other hand, cryptocurrency, and Bitcoin in particular, introduces a deflationary force by means of a fixed supply and decentralized issuance. In his argument, Pal contends that this dichotomy is causing a seismic shift in the psychology of investors, which is driving capital toward digital assets as a hedge against the dilution of the systemic monetary system. According to him, the future of finance will revolve around tokenized assets, financial rails based on blockchain technology, and a macroeconomic environment in which fiat currency continues to lose its purchasing power. This will make Bitcoin and cryptocurrency native ecosystems increasingly important. Now let's listen. Raoul Pal.
So talk to me when you started as a macro strategist, what framework did you build? How did you think the world worked in terms of, were you looking at ISM and cyclicality? Were you looking at, more traditional economic flows? How were you looking at things, and how has that evolved as time went on?
So I essentially started my trading career at the trading floor right after Lehman, right? So I'm born and raised in a world of QE. I have no clue how markets work without QE. I'm not really, I don't really have a background where I can talk about how markets work before central banks got involved to the extent that they are today. So I think the first task,
which is probably a plus point, I would say, because you're not scarred by how things should be, but you're dealing with how they are.
Yeah. Yeah. And one of the things that led me to where I am through that 2010 to 2020 time span was that I kept saying that interest rates would be artificially suppressed by central banks because that was the only thing I knew. And it proved to be a right point. And therefore, the framework I started building was very centered around central bank balance sheets and how they impacted bond yields. That was essentially my first thesis. And I remember the very first interview I did with one of your colleagues at Real Vision back in maybe 2014, something like that, was about how QE impacted bond yields in the opposite way of what the consensus was. Because every time
I remember this. You were saying bond yields go up every time there's QE, and everyone was thinking they're buying bonds and bond yields should go down. I remember seeing that going, huh, he's right.
Yeah, and it actually proved to be right for quite a few years in a row. I've struggled with that thesis for the past couple of years, and you and I have talked about bond yields over and over on shows, and we haven't really gotten it right a lot of times.
I can't trade bonds anymore. I used to be really good at bonds. I just cannot get them right.
No, it seems like this thesis that central bank balance sheets impact bond yields in the way you just described is not really working as it intended anymore. So we need to come up with a new thesis on that. But that was my first thesis, and it played out very beautifully. And then I moved on from there to try and assess, okay, how is this central bank balance sheet regime going to impact across assets? And that was essentially also what ultimately led me to consider crypto as an asset class. Too late compared to others, but the whole notion that central banks would get involved to the extent that we've seen over the past 15 years or so was something that I was just thrown right into that mix. I started trading exactly when this became a thing. So it was my journey to become a trader and become an analyst in that environment. And that's why I've always focused on that. And I don't think anything else matters for
And when did you start Steno Research?
After the pandemic. I actually spent maybe 10, 11 years at Nordea, ended up as like the global head of the strategy and research team. But ultimately, during the pandemic, I got annoyed with all of the rules that were implemented about my ability to speak publicly and all of that. So Nordea basically ended up more or less as the rest of the pack in the investment bank space, trying to limit strategists from tweeting stuff and so on and so forth. And I've always been a contrarian thinker, and when you start seeing rules like that being implemented, it's impossible it's just not possible to be a contrarian in such a setup, right? So it led me to open my own research shop, and I've never, really looked back since. It's been the right move, and I enjoy being able to speak my mind.
There is a strong possibility that Bitcoin is on the verge of its next significant breakout, which is supported by a convergence of on-chain signals that indicate that the market is becoming increasingly powerful. The cryptocurrency Bitcoin is exhibiting signs of stabilization after being subjected to persistent selling pressure for several months. As profit-taking decreases and long-term holders, who have traditionally been known for holding through volatility, have begun to capitulate, it appears that seller exhaustion is beginning to take hold. The final stages of a market bottom are typically marked by this kind of behavior, which is indicative of a reversal in the market. In addition, the rate of institutional selling, which had recently reached high volumes, has significantly slowed down, which indicates that large players have lost their confidence. At the same time, a significant change in the patterns of coin movement has emerged. Approximately 2,000 bitcoins, which are valued at approximately $162 million, have been transferred from exchanges into private wallets, which suggests that a phase of relatively quiet accumulation is currently taking place. The price of Bitcoin has already increased by more than 3% in a short period of time, and with the selling pressure decreasing and the strategic accumulation increasing, a breakout may be closer than most people anticipate. Watch the video ahead.
One of the things you talked about is, you were very early to understand, because you knew no different, that the central banks were large players in how economies and markets work. Did you realize early on that governments were in cahoots with central banks, and that they weren't now separate entities, even though they claimed they were? They weren't, because you've been a pioneer of the flows of this kind of stuff as well. When did you start to realize they were actually working all together in concert with each other?
To be honest, Raoul, I think it became crystal clear to me in 2020, not before.
I agree.
We had a bill to pay in one way or the other during the pandemic. Everyone had to get a bailout, and it was impossible to fund that without central banks ultimately funding the issuance of all of the T-bills and sovereign bonds issued worldwide. And it felt exceptionally coordinated, and it probably was coordinated between treasuries and central banks, what happened in March, April 2020.
And globally coordinated as well,
yes,
amongst all of them.
Yes.
Because we kind of thought that in 2008, but we didn't really see evidence, maybe in 2012 with Draghi. But then we weren't sure. But yeah, this was like, oh, they're all the same thing.
Yeah, and then Silicon Valley Bank happened, right? It was on a Friday afternoon. And remember this rule of thumb, right? A bank will always go bankrupt on a Friday afternoon. So you have 48 hours to fix stuff before it reopens. And between Friday afternoon and Monday morning, the US Treasury and the Federal Reserve fixed it. And they coordinated it once again, right? Liquidity injections, and the Treasury basically backstopped banks at the same time. So, the last two major crisis events, it's not even been, it's been transparent that they work together now. It's actually not something that they're hiding anymore, which is something new. I think they worked together back in '08 as well. It was right about when I started my trading career, but it wasn't transparent that they did so. But it's been pretty transparent in 2020 and in 2023 with Silicon Valley Bank. So they're not even trying to hide it anymore. And Janet Yellen's one of her final remarks as the Treasury Secretary was this remark around the ability to afford the debt load of the US Treasury. And she basically told the Federal Reserve that we cannot have interest rates at this level for a prolonged period, because then we're not able to finance this. And it wasn't really even hidden. It was in kind of in officialese terms, but if you understand officialese, it wasn't it. It was a clear hint to the Federal Reserve that they would have to bring interest rates lower, which they did during that autumn space, right? So it's not hidden anymore, Raoul. It's out there, and it's something we'll have to deal with.
So now we've got Scott Bessent, who is macro guy, so he understands the game. Interest rates are still way above GDP growth or whatever. It's so interest payments keep escalating. What are they going to do here? How do they get out of this mess of just because they're going to have to debase currency a lot to pay for all these instruments. What's your kind of framework of where we are and how this is going to solve itself in this cycle, not in the long term? We'll talk about the long term in a bit.
Yeah. So, we're approaching a massive refinancing cycle right now. And that's something you need to consider when you assess central bank balance sheets, bond yields, and the impact across assets, because we're not going to make it through the next 24, 48 months without lower bond yields. I essentially rule that out. And if we get a market that is not willing to play ball, the central bank will essentially have to solve it. So how do we get to a point where the central bank needs to step in? I think they're kind of engineering that scenario right now in front of us. We basically need a market that is sufficiently weak for the Federal Reserve to be able to use the excuse that financial stability is threatened. Because with inflation running a little bit above target still, even though I think it's declining here, and with a debt load that is as fierce as it is, they'll have to be able to use this financial stability excuse to come up with some sort of way of solving this.
So you're suggesting they have to break something?
Yeah. At least I think it's a valid thesis here, because otherwise I think they would have stopped a few weeks ago. That's point number one. Point number two is that if the central bank is a little bit scared of restarting QE for a list of reasons, whether they're political or whether they're related to the inflation pressure, they could find alternative ways of asking the private system to buy the bonds for them. I've floated the idea that
This is why I've been using total global liquidity as almost a better measure, because they're using the private sector.
Yes. And that's a new thing, because, a couple of years back during the pandemic, it wasn't needed, but it's needed now. So they have a couple of options here. One of them is to basically, via regulation, force banks to hold more US Treasuries in their liquid assets. And, if a bank is forced to do so, it happens, right? They cannot do anything about it if they're forced to do so via legislation. And I think that's a very simple way of solving this. So I've talked to a lot of guys telling me that the Fed is cornered here because inflation is too high for them to restart these bond backing schemes. And Well, my response to that is basically, well, then they'll force someone else to fix it. And they could easily do that, even if, let's assume that the Federal Reserve will kind of turn a little bit political here against everything that Trump is doing. Let's just assume that. The Trump administration could itself impose these rules on banks, right, via all sorts of tricks they have up their sleeve. So I don't think that will, avoid some sort of situation where the private sector will have to accept being used as a funding vehicle here. And there are many ways of solving this.
The other way is
the Trump administration could do it itself, right? Yeah.
There's also the pension system. I mean, Europe did this decades ago, which was force the pension system to hold more bonds. There's also the insurance sector. You can force them to hold more bonds. There's infinite bond buyers. People are like, well, if China don't buy bonds, it's the end of the bond market. I'm like, no, there's trillions of dollars of savings sloshing around between the insurance companies and the pension plans, and then the banks. That liquidity alone is enough.
The Trump family's foray into Bitcoin mining, a historic step for crypto legitimacy, has garnered industry-wide attention and marked a significant change in the political and economic discourse surrounding digital assets. The Trump sons are entering a quickly changing industry by partnering with top mining company Hut 8, which will give high-profile credibility to a sector that has faced image and regulatory issues. This strategic alignment occurs as the United States assumes a leading role in mining operations worldwide following China's mining ban in 2021. The Trump move, according to G Mining CEO Mark Zalen, is a strong endorsement that will increase investor confidence and attract capital to mining projects in the United States. U.S. miners now operate in a more advantageous and encouraging environment, thanks to Donald Trump's own support for a national Bitcoin reserve and regulatory clarity from organizations like the SEC. There are still issues, though. Smaller mining operations are facing increasing cost pressures, and the industry is still being criticized for its excessive energy consumption. Larger companies are responding by diversifying into data center services and artificial intelligence, AI, and implementing sustainable practices like hydropower to increase resilience. States like Texas, Florida, and New Hampshire are promoting Bitcoin reserve legislation, providing tax breaks, and establishing advantageous regulatory frameworks in an effort to further accelerate this trend. States are now competing with one another to draw in mining companies, which is fostering innovation in the cryptocurrency industry, infrastructure investment, and job creation. A new, more robust chapter for Bitcoin mining and U.S. crypto leadership may be ushered in by the Trump family's involvement, which could signal the beginning of a wider institutional and political embrace. Thanks for watching.